All right. Welcome everyone. Welcome. Hopefully you guys can hear me. Yeah, you guys can hear me. All right, perfect. I have to look over to my mic here. Okay. Yeah, so hopefully you guys can hear me with clarity. And let's bring the music down a little bit, just a little. There we go. All right. Okay. Well, welcome guys to this very impromptu live stream. Oh, thank you guys for the likes. Wow, thank you. I haven't even really started yet. But thank you. So as I've said in the title, right? I clearly wrote this is it, period. Okay? And so the reason being is that, first of all, if you guys remember, I went live 3 weeks ago. It's not exactly 3 weeks ago, but it's about 3 weeks ago. And I've done a live stream where I was talking about the potential for our first market crash of 2026. And I have linked that down below in the description box. So make sure you guys click on that link and check it out once this stream is over. Okay? So the reason why I'm saying this is that, well, I've gone over some specific levels. I've gone over kind of the macros and kind of the overall view of the markets 3 weeks ago. And so basically this video is going to be, or this stream is going to be kind of an update and giving you guys more of a clear picture as to what I'm currently thinking about the markets. And again, this is all of my opinions, my true honest opinions on the markets. Okay, and if you guys think otherwise about my analysis or my thoughts, that's fine. Okay, but let me first begin first with the fact that, well, the markets weren't too hot today. Okay, we ended up at negative 1.54%. And there could have been a larger move to the downside. We could have been at negative 2%. Who knows, right? But why did the markets go down today? Okay, and first of all, okay, the entire market is kind of put in a chokehold of paranoia, right? The markets are overall paranoid, but specifically paranoid about the AI revolution. Specifically, even to be more specific, the AI disruption. And the AI disruption trade has caused havoc, right? It's wreaked havoc across multiple sectors like software, real estate, and now even financials, okay? Specifically private wealth managers, all right? But you guys should already know that by now, right? Oh, hopefully you guys should know that by now. Since the markets have been really just moving in an odd manner, especially the overall markets, as the markets are still near all-time highs, right? I mean, based on what I've just told you guys there, it's kind of ridiculous to tell you guys that the markets are at all-time highs, but here we are, right? But if you guys just take a look and cycle through each individual sector, you guys will see that all those sectors that I've just mentioned are down a lot. So the markets are clearly fearful about what the AI disruption is going to have on the overall markets, individual sectors, and overall economy. Okay, so I'm going to be going a little bit deeper into kind of this effect of the current AI disruption trade and what it means for the overall broader economy. All right, so first of all, hey, what's up guys? Thank you guys so much for the likes. Make sure you guys hit that like button down below if you guys just came in. Okay, so with that being said, okay, let's first go over the jobs report that we got yesterday. All right, so before I talk anything about the markets and the analysis and whatever, okay, let's first begin with the actual jobs market, data that we got. Okay, so yesterday we had the U.S. employment rate and U.S. unemployment rate. So jobs came in at 130,000 jobs, all right, and the expected was 55,000 and the previous was 48,000. So hey, that's a great jump, right? Again, this middle column here is the median forecast, and the last column here is the previous, and obviously the left one here is the actual value, right? So 130,000 jobs were added. That's great. There was some growth. And then the U.S. unemployment rate sits at 4.3%, so there's a 0.1% decrease from the previous reading of the UR. So okay, so this is great, right? So in aggregate, right, in total, this U.S. employment report showed a nice growth in jobs. But guess what? Most of the aggregate total amount of job growth came from the healthcare sector. Okay, so what does that mean? Okay, so first of all, when we tend to see healthcare jobs growing at a faster rate compared to all the other sectors, for example, like the volatile tech sector, okay, that usually means that the economy could be stagnant, right? The US economy could potentially heading towards stagnancy, right? And again, you might be saying, wait, why is that a thing, right? Because again, if healthcare jobs are going up, right, then that means the overall markets and the overall economy is being worried about the fact that the usual growth sectors like the tech sector, a volatile tech sector nonetheless, okay, stops showing any type of growth. And we've seen this in the last couple of months, okay, or any type of job openings, all right? That usually means that people are starting to focus a bit more on the data where we start to look for a human part of the jobs report. And what I mean by that is taking care of humans, right? So obviously, you know, insurance companies, healthcare companies are going to get a lot more attention, right? That's the reason why we've been seeing the healthcare sector, you know, specifically insurance companies, seeing a nice rise in share prices for the last couple of months, right? Because people are understanding that, hey, you know, if we're seeing this big AI disruption, right, there should be one specific sector that is, first of all, number one, a defensive sector if you're actively investing in the markets, and number two, AI will most likely not be able to touch this sector for years to come. And what is that sector? Well, healthcare. And in fact, right, since the markets are so paranoid about this AI disruption trade, okay, the healthcare sector is actually going to be most likely benefiting from this AI disruption, right? In fact, it's not even the AI disruption for the healthcare sector. It's most likely an AI enhancement, all right? And there's one specific example, okay? So there's a show that I'm watching called The Pit. If you guys have heard of it, it's on HBO Max. And they recently touched on this subject, where AI can actually be a great way to reduce physicians' charting time. So if you guys aren't familiar with the healthcare industry, or you know, if you guys aren't pre-med students, or you've never gone through the pre-med courses as a college student, or we even went to medical school, you guys should understand that physicians and doctors, and you know, they go through hours and hours of charting where they have to either physically, well, most of the time they have to physically type out patients' report, right? Well, whatever they did that day, or etc., right? For future doctors to look at, or for future the physicians to look at, right? So the AI in this specific episode in the Pit, in the show, they showed that AI can potentially bring down charting time by a couple hours, and that could potentially be a nice trade-off for physicians to focus even more time onto the well-being of their patients, right, during the visit of their patients. So that is something that I think it's interesting, although I'm pretty sure that type of technology is not really accurate just yet, right? Even though in the show it kind of showed a pretty good accuracy with that AI technology that they're using for doctors to chart. But I think, you know, with this progression of this exponential growth in AI, especially if it's going to be enhancing a sector like the healthcare sector, I think in the next 2 to 3 years, right, maybe even 3 to 5 years, we could be seeing a significant benefit of AI integration into the healthcare sector. So again, we are starting to see the markets expecting, and the overall economy to be expecting, that we're not going to be seeing any type of significant economic growth, right? We've been seeing, especially, here's a great, here, I just remembered something, guys. Here's a great indicator that the jobs market is slowing down and the overall labor market is showing cracks. College students, right, recent graduates, are not seeing any opportunity to get into the labor market, right? whether it be white collar jobs or even blue collar jobs, for example, if people aren't from college, right, from university, if they're not graduating from university, maybe they just came out of high school and they're looking for a blue collar job, right? So right now, college students, college graduates are not able to get a job even if they're qualified for it, right? In their degrees, in their specific areas of studies, right? So this is something that I think is a true indicator that the labor market is starting to really slow down. And that is a huge warning signal, a huge red flag. It's not even a yellow flag anymore. I think I mentioned a yellow flag in that live stream 3 weeks ago. So this is a true red. Again, in aggregate, in total, the US employment report from yesterday showed some pretty good results. But again, you have to look under the hood. Most of these jobs growth came from, well, the healthcare sector. And that is a sector that is usually pretty stable. Why? Because over time, we're going to be seeing more and more humans becoming older, right? The overall global population is going to start to see a decline, or not a decline, but a decrease in population growth, right? We've seen this multiple times in the past as well. If you guys studied, stuff like, history, or maybe even what is that, anthropology? I think they study stuff like that. I don't know. I'm not an anthropologist. I don't have a degree in anthropology, but anyways, so this looked great, right? But now let's translate this report onto the actual market, because what happened yesterday, guys? We had a small gap up on a pretty positive report, an uplifting report. But what ended up happening was that yesterday, we continued to move down immediately after market open. And what we saw next was, well, yields started to go down, right? If you take a look at the 30-year Treasury bond yield, right? We have, excuse me, I meant down, sorry. The yields have started to go down, right? And what we're seeing here, especially the 10-year yield as well, right? Let me actually show you the both yields here. Okay, the 10-year yield is a bit more relevant here. Okay, so 10-year yield has also moved downward. Okay, ever since that report. And if you take a look at bonds now, okay, let's take a look at TLT, right? This is the 20+ year Treasury bond ETF. It has seen a pretty big push to the upside. So what does this mean? Right, what could this all possibly mean, right? Especially after we just got this pretty critical and crucial data for the labor market, for the overall labor market, right? So this means that, well, people are getting pretty, not scared, but they're getting pretty defensive, right? They're saying that, okay, well, if most jobs are going to be disrupted by AI, and if you're not going to see any type of growth in the actual, sectors and areas that matter for economic growth and overall labor market growth, which is again the volatile tech sector and other subsidiary sectors, okay, then we should be buying bonds, right? We need to have some sort of stability here, and we should be moving our money out of the equity markets and into the bond markets. Okay, so this is something that I think it's pretty interesting to me, that we're starting to see bond prices moving up higher, and obviously from an inverse relationship perspective, yields coming back down. Okay, and to me, this signifies that for the overall market, right, it's finally going to happen. We're starting to see the markets curl downward, and we might be seeing that critical, potentially, potentially, first market crash of this fiscal year of 2026. Okay, and so now, before I move on to the actual analysis of the S&P 500 here and the VIX, okay, we also have yet another critical data coming out tomorrow. Okay, and that is the CPI report for this for last month, January. All right, so let's quickly go over it. So first of all, I'm going to just be looking at the core CPI. Okay, that's kind of what matters the most. So last time it was at 0.2%, and now they're expecting a slight increase, right? The core CPI for January, 0.3%, right? So they're expecting a slight increase of 0.1%. And then for the core CPI YOY year over year, they're expecting a slight decrease of 0.1% from the previous reading. All right, so this is December's reading, obviously, right? So again, with inflation, okay, I think so. Here's my actual opinion. Okay, so there's a lot of people. That are saying that the inflation report is going to matter a lot tomorrow, and I somewhat agree with all that talk about the CPI report tomorrow. And the reason being is that, first of all, the markets are most likely reacting to what the Federal Reserve is going to do, okay, in the next FOMC report based off of all the data that we've gotten on Wednesday and today as well. This initial jobless claims as well. I mean, this is clearly, I mean, there's been an increase, right? There's been a decrease, right? Because again, the employment report saw a big, nice push, right? So it kind of makes sense that initial jobless claims, which is again, it's a weekly report, showed a slight decrease, okay? But again, the overall markets are always going to start pricing in what the Federal Reserve is going to do next, okay? And this is going to be even more crucial after tomorrow's CPI report. And so I don't think that the markets are going to be reacting off of what the CPI report is going to be, right? What the actual values are, but it's going to react to is how the Federal Reserve is going to react to both the data that we've got from the initial January jobs report and January CPI report combined, okay? But most importantly, I think the Federal Reserve is one. There's not just me thinking that it is, but the Federal Reserve will most definitely going to be looking at the labor market and the overall situation of the labor market. Why? Well, we've heard from last year from Jerome Powell multiple times that Jerome Powell and all the other Fed governors are starting to become a little bit more wary about the labor market, and the fact that their dual mandate of controlling inflation and bringing back price stability while also providing kind of a nice cushion for the labor market is starting to not work out. And in fact, they might have to handle the potential for the labor market to crack. And again, it is showing cracks with Wednesday's report, okay? And they are going to have to handle inflation as well. They might be seeing inflation continue to tick up higher. So with unemployment rate potentially heading up higher and inflation potentially starting to increase again, this is not good, right? This starts to bring uncertainty to the Federal Reserve themselves. And again, uncertainty, that is the main key word. The markets are uncertain about every single thing. Okay, so now it's not just the Federal Reserve's potential reaction to this current data that we're getting, but it's also that uncertainty when it comes to the AI disruption trade. We don't know what type of jobs, we don't know what type of technological disruption we might be seeing with AI, right, in the short to mid-term. That's the reason why we're starting to see a lot of sentiment shifting to a bit more of a fearful stance on the overall economy and a lot more of a bearish sentiment in the overall markets. And that's exactly what we got today. And that's the reason why today we're starting to see a big, massive push lower as the overall macros on the overall economy and the overall markets are starting to flip to the downside, and the price has followed that. Right? And today was a clear example of a day where the markets are really wanting to price in, or at the very least start to price in, that's a better word there, the potential for the Federal Reserve to put its next plans into action, whatever that may be. And I'm gonna keep that for my CFO Swing Watch Report readers. Okay, and also what this AI disruption trade could bring about in the next, well, not even just the next year, but into the end of this decade, right? The 2020s. Okay, so now, with all that being said, okay, let me go over the overall markets. Let me do a full technical analysis on the markets. Now, before I begin this analysis, let me show you guys what I wrote to my CFO Swing Watch Report readers and the private CFO Discord members by showing you my actual Discord here. Okay, so let me bring it over here, slide it on over. Okay, let me now show you guys my channels. Okay, so again, if you guys want to have access to my private CFO Discord chat room, make sure you guys become a reader of the CFO Swing Watch Report, because if you do, if you guys become a reader, you guys will get complete access to the private CFO Discord as well, right? So you get 2 for the price of 1. And again, the CFO Swing Watch Report alone is worth it. Okay, so here's what I've said last night. Okay, yeah, well, yesterday afternoon and last night. I'll be showing you guys the relevant messages here. Okay, so let me start from here. Right, this is kind of worrying now. Right, I think I meant this is kind of worrying me now. Individual stocks continue to move, but the overall markets have barely budged since this year started, and we're almost halfway into the first quarter. I've also, by the way, mentioned this last month as well, in January. Okay. And the fact that, well, actually, this specific fact was provided months ago in November and December of last year, that market vol might be beginning to expand and we might be seeing elevated market vol for most of 2026. Okay, and so far, I have been correct on that. And I know, it's only been a month and a half so far into this year, but so far, I've been correct. Now, let me go back to the messages here. So, not trying to be too biased to the downside, but the data is right there in our faces. At some point, all these rotations and all these market breadth holdups aren't going to hold up the entire market for us. Gotta remember that. Okay, and then at 2:18 p.m. yesterday, after market close, I said, this is what I'm worried about here. Right? So, you guys can see it pretty, I don't know if you guys can see this, but this is the RSI down here. Right? I can show you guys this on here too, but clearly, the RSI is having lower highs and lower lows, right, at specific spots, but overall, the trend for the RSI, or the Relative Strength Index, is lower highs. Meanwhile, during this entire trend here, this arrow that I've drawn, right, if you just look right up here, right, if you just go right up the screen, you see clearly that the overall markets have making higher highs and clearly higher lows. Okay, so this is a pretty, well, not just for me, but it should be a very worrying indicator to you guys, right? To everyone, right? We're seeing this divergence, right? And this, this specific RSI divergence is a bearish one. On top of that, right, SPY yesterday was at the highs, right? It was near the all-time highs, where you guys can see right here too, right? Right, around the 696 all-time high resistance level. And at that high point, SPY was making it is still making a massive rising wedge. All right, I mean, if you guys are comfortable with making chart patterns with your own naked eyes, you guys should be able to clearly see this. Okay, so again, a rising wedge is inherently a bearish chart pattern. Okay, and here's what I said. At some point, something has to break in order for this daily RSI trend to be confirmed. People. And there are plenty of individual growth stocks that have gone down and closed at lows too, right? And I said best to hedge. And guess what? I said this specific statement, hedge, since late last year, since like, I think like mid to late November, and in preparation for this fiscal year. And again, I think this is gonna be my motto for this year, guys. Hedge. Okay, really, hedge. And then I said, just lots of dead cat bounces if anyone has noted as well. And again, a lot of bounces, right? And these are dead cat bounces. Why? Because again, these bounces so far, right? So let me just bring it here again. All of these bounces here, ever since back in late November, right, haven't resulted in a significant move to the upside, right? And in fact, for the past couple of months, based on today's closing price, or even just yesterday, right, we haven't moved much for weeks and for months, depending on where you're looking at in the chart on the daily time frame. So again, lots of dead cat bounces. Okay, so now let me also go down to here. Okay, So here's one of my members. They said, I'm surprised the indices are so high when there has been so much correction underneath the surface. And I said, good point. It's because we're seeing such a huge rotation into defensive, value, and anything related to dividends. And I said, take a look at this specific ticker. Ticker symbol DGRO. So, if you guys don't know what that is, I'm bringing it up for you guys. Alright, this is the iShares Core Dividend Growth ETF. Do you guys see a clear difference? I don't know if you guys see this or not, but clear difference from the S&P 500 ETF to DGRO. I mean, what do you guys see here? Just take a look at from November, right? November's price action to SPY's November price action. Okay, right around here. What do you guys notice? Let me know in the chat here. Let me know. Here, right here, and let me actually go closer. And here, what do you guys see? Can anyone tell me? Okay, I see you guys' reactions, but let me know in the chat. What do you guys see there? Okay. Well, I don't think anyone's gonna answer. Okay, so clearly, right, we're seeing. Yeah, there we go. Well, oh, there we go. Thank you, Joe. It's moving up, right? So this is the dividend growth ETF, right? Compared to SPY. And guess what? DGRO has been making new all-time highs, all right, since December. While SPY has made a new all-time high, but essentially we've gone sideways, right? Even if you were to just look at the closing price of today with each individual ticker, right? SPY still hasn't gotten anywhere with today's closing price, while DGRO is still at it's pretty close to its all-time high. And again, guess what? DGRO has made a new all-time high today at 74.28. Okay, so that's what I meant yesterday in the private CFO Discord, right? That investors are rotating into defensive, value, and anything related to dividends, right? It looks completely different to SPY. Okay. Now, there's also been some pretty alarming stuff about the labor market, because if you guys take a look at the previous data for the labor market and any of the labor market reports that we've been seeing, especially the employment, right? There has been a lot of revisions. And so far in total, those revisions have basically told us, guys, and this is true, I'm pretty sure I'm getting this right, we've lost basically almost 1 million jobs last year based on those revisions. And again, if I'm wrong about that, if my memory is not serving me well, my apologies, but the overall sentiment here, based on that value, based on the revisions, excuse me, has been that we've actually lost jobs last year. Okay, and that has continued this year, but thankfully, what has been growing, guys? What specific sector has been growing? The healthcare sector. And that's great. Wow, that's amazing, right? Not exactly. As I've stated earlier in the stream, that's not that much of a good sign. That just means that, hey, the overall economy is most likely going to be heading towards stagnancy. And the markets, especially the equity markets, are not going to like that, right? Because the markets are going to move in preparation, or at least it's going to price in the future perception of the overall economy. And so if the economy is stagnant, well, the markets won't like that, right? We've also seen bond prices moving higher, right? That's yet another indication that everyone is becoming a bit more defensive, right? If they're not looking to short the markets. So that is what I'm worried about, right? This is why I'm saying this is probably the final moment. This is it, right? Where we're starting to see a breaking point, a point of no return, where even if the economic data, whether it be for inflation or the labor market data, is positive, right, are positive, I don't think the markets are gonna like it as much, right? Because the markets are anticipating and moving in perception of what the Federal Reserve is going to do in the future, right? And again, the future can mean the next upcoming FOMC meeting in March, or what they will be doing for the entire fiscal year. Okay, and so again, when that term stagnancy comes up, I hope one specific term comes up in your guys' head. And what could that be, guys? What could that be? Stagnancy. What type of word could be potentially popping up inside of your own heads? Anyone? Anyone? Don't be shy. Okay, please don't be shy. You guys can put in the live chat room. Okay. Hey, do nothing. Yes, you got it right. Stagflation. All right. Well, obviously, do nothing is a reader of the CFO Swing Watch report. But I have been talking about stagflation all of last year. Actually, last year, I think, what? Earlier last year in 2025? Yeah, I think so. But I've dropped that term, this term stagflation, throughout last year, and now it looks like this term is about to become reality for us, right? Because stagflation means we have a stagnant economy that has no growth, little to zero growth, right? While unemployment continues to rise and inflation continues to go out of control. Okay, thankfully, we have not yet seen inflation completely going out of control, even if specific prices like food have gone up a lot since 2025 or 2024. Okay, and again, food prices and energy prices are usually very volatile. All right, and if you guys know anything about inflation and you know the CPI report or even the PPI reports, you guys should understand what that means. Right. So, anyways, however, right, with yesterday's report, it's looking a little bit shaky with the labor market, right? Again, I don't think the markets are going to be reacting too much to the overall inflation report, CPI or PPI, or even the PCE report, right? Again, the PCE report is what the Federal Reserve goes off of to judge and make their actions on the federal funds rate or the interest rate, right? The benchmark interest rate. But again, I think it's the labor market, right? They have to attack two different things at once, right? Inflation and labor market. Now I think they're gonna have to really focus on the labor market while kind of putting inflation on the back burner, which is not good, right? Because we've seen inflation rise up for the last couple of months, starting from last year. So again, this is not good. So with that being said, okay, So with that being said, okay, let me do my final, okay. My final analysis on SPY before I give you guys another update, maybe a few weeks down the line or maybe a couple months down the line to see where we're at, okay. But for SPY, all right, if you take a look on the weekly time frame, we've barely made a dent to the downside. I know for some people it seems like there's been a huge major correction, like what my member said here, one of my members, one of my readers as well, to see if it's Watch report, right? The indices are so high when there's been so much correction underneath the surface, and that's correct, right? Well, even with today's action, okay, we're not seeing much, right? We're still at the all-time high levels, right? And again, I've told you guys to make these 3 or 4 levels on your own charts, right? The 694 level, 686 level, 675.50 level, and 670 level. And guess what? Even if SPY decides to come back down to retest 670, that's nothing. Okay, we're still gonna be pretty much back, pretty much near the previous all-time high area, which is again from 675.50 to 686. So again, you guys have to think about this in the broader perspective, the bigger picture perspective. If you were to have a market correction of -10% or even more, negative 20%. Because again, a lot of people are getting very, very bearish now. I've talked about that complete shift in sentiment as well, right? Earlier this stream, right, in this live stream. So if I were to just go from the current all-time high price print of 697.84, I've done this on the report this week. I give you guys a specific percentage, but let me just do a very brief showcase of how far we've fallen from all-time highs. Okay, I'm trying to make it as accurate as possible. Okay, there it is. We have only fallen about negative 2.30%. Again, we have only fallen negative 2.30%. Isn't that crazy? It seems like we're already in a bear market, right? Due to all the individual names, especially the leading tech sector, which has the software sector, has been completely obliterated, right? And that alone makes us feel like we should be in a bear market. But then again, if you just take a look right here, we are not, okay? And it's quite funny, isn't it? Something feels very off. And the markets have only gone down negative 2.30%. So let's kick it up a notch and go down to 670. How about that? Okay. As accurate as possible here. Okay. That's only going to be almost negative 4%. And guess what? Just like I've said earlier, that going down to retest 670 won't be much. Because again, as seen here with the percentage move down from the all-time high price print, it's only about negative 4%. And that's basically just a simple market pullback. Okay? Because again, market corrections usually begin from 5% from a previous high point. So things are very, very interesting. All right, that's all I say here. Interesting and also very fishy. All right, the fact that the markets have held up this long, right? Because the overall slaughter in the software sector has been going on for about 2 months now, 2.5 months, almost 3 months now. All right, since last year, late last year. So this is becoming quite alarming, right? The fact that the markets are only down about negative 2.30% from all-time highs, and even if you were to come back down to 670, that'll only be a small market pullback, right? That's nothing. So if you were, now, let me see. All right, let me show you guys this. All right, now I want to see this as well. I haven't done this in a while. If you were to go down even just negative 10% to fully come full circle of a textbook market correction, right? Okay. We should be around 628. Okay? And that's still not even that of a big move to the downside. Look at this. Alright? Oh. Well, you guys get the gist of what I'm saying here. Right? Let me see. Let me bring that back. If I can. Okay. There we go. Okay? So let me try to be as accurate as possible here. Bam. Okay. It should be around 627 to 628. Okay? And that's just a regular market correction. Right? We should basically be retesting the weekly 50 SMA here, this dark blue line. Right? So to me, this feels like we should be coming back down to retest the weekly 50 SMA. And that is the reason why, if anyone is here right now watching either the stream or the replay of the stream, all right, that's the reason why I gave everyone this specific hedge, all right, on SPY, using SPY puts, right? I'm currently holding that right now, all right, and I think ended up almost 40% to end the day on this specific hedge that I gave everyone yesterday. All right, so this is a pretty good look to what I'm in right now. Okay, excuse my I wasn't able to bring out the right word, right? This is what I'm in now as a hedge. I said SPY 630 put contracts on the expiration date of April 17th. Okay? And that is the main reason why I've chosen 630 strike puts, because this will become at the money, or potentially, maybe even in the money, if we were to complete a textbook market correction of negative 10%, maybe even a little more, and that will bring us down to around 627 or 628 from the current pivot high point. All right, so if anyone saw my hedge yesterday, this is the reason why. But also to completely be able to profit off of a textbook market correction of negative 10% from the current all-time high price print. Does that make sense, everyone? Okay, so I gave you guys a little nice free hedge there, or maybe a nice short position there. Okay, so last but not least, let me go over VIX. All right, basically, obviously, if you guys don't know what VIX, you guys should know what VIX is. This is the volatility S&P 500 index. Okay, all right, and this is something, this is something that is inverse, right, to what the markets are doing, specifically the S&P 500. And I want to make sure that you guys understand why I've been saying that the VIX has been an important part of the overall analysis. Again, as I stated last year, even back in I think it was August or September, that VIX will have this affinity to this value of 20. And guess what? We've been doing that ever since, right? We continue to have this magnetic affinity to the value of 20. All right, and so I think this is something that you guys should be looking at, right? The VIX, and I really don't have much to say other than that, right? Because again, this is basically the inverse of the S&P 500. If the markets go down, then VIX will have a nice pop up higher. Okay, all right. Well, that's a pretty long impromptu live stream, but hopefully this is a very insightful one. All right, so yeah, I'll see you guys next week on Monday. Hopefully at the same time at 8 p.m. Pacific Standard Time or 11 p.m. Eastern Standard Time. All right, have a great rest of your night and good luck tomorrow.